In 2019, Uber lost $8.5 billion, and investors still valued the company at $82 billion. That number isn't a typo. So why would anyone pay billions for a company that was losing billions? If your local business loses money every year, you don't call it a success. You call it a problem. So why does the logic change when investors look at a startup? Because they're not always asking, how much money does this company make today? They're asking something much harder. How big could this become? And that one question can change a company's value by billions. Uber wasn't alone. Amazon spent years prioritizing expansion, infrastructure, and customer growth instead of maximizing short-term profit. Netflix poured money into content and international expansion while building a global subscriber base. Different companies, different industries, but the same basic bet: spend now to build something that could become much more valuable later. Because sometimes, the money a company loses today is being used to buy customers, infrastructure, technology, or market position. Think about what that means. An investor isn't necessarily looking at a company's current profit and saying, this is worth billions. They're looking at the business, the market, the growth, the competitive advantage, and asking, what could all of this be worth if it works? That's why startup valuation can look completely disconnected from today's profit. The price isn't only about what exists, it's also about what investors believe could exist. But there's a dangerous side to this. Growth alone doesn't create value. WeWork reached a $47 billion valuation in 2019. Then investors looked more closely at the business, its economics, and its risks. Its planned IPO collapsed. Years later, WeWork filed for bankruptcy. The lesson: a brilliant future story is still just a story until the economics eventually work. So go back to Uber. That $8.5 billion loss wasn't proof that the company was worthless. But it wasn't proof that investors were right either. It was a bet that today's spending could create tomorrow's scale. And that's what investors are really doing when they fund a loss-making company. They're not buying today's company. They're buying tomorrow's possibility. And sometimes that possibility becomes enormous. And sometimes it becomes WeWork.